So you've probably heard dividend irrelevance theory bandied around on the internet. And it proposes that dividends are meaningless to a stock's price, that a stock that pays a dividend and doesn't pay a dividend, that you'll be equally wealthy at the end of it all. And there is some truth to this. On the ex-dividend date, if a stock's paying a $2 dividend, the stock price will drop exactly $2 on the ex-dividend date. But this is mistaking the voting machine for the weighing machine. The theory argues that when a stock you own pays you a $2 dividend, that you are not becoming $2 richer. You're just moving $2 from one pocket to the other pocket. But I argue that dividends are just one of many forms of capital allocation. Sometimes they're right, sometimes they're wrong. There's such thing as too much dividend, there's such thing as too little dividend, and that it is not a zero-sum game. And also that arbitrage plays a big role in the ex-dividend day drop. Even though the ex-dividend day drop is built into the markets themselves, it is a law of physics. It is predetermined by the market makers, by the NASDAQ, by the New York Stock Exchange. But arbitragers prepare it in advance. So in this video, I'm going to try and take down 3 big claims of dividend irrelevance theory and its proponents. The first is that if you have 2 identical companies and one says it's going to start paying a dividend and the other one retains the money, that years and years from that date, you will still have, assuming no taxes, the same amount of money if you sell all the stock, hold all the dividends, compare it all together, right? That say one goes from $10 a share to $20 a share, the other will have gone from $10 a share to $15 a share, and you'll have $5 of dividends per share. That's the first claim. The second one I want to go after is that buybacks are just superior dividends. The buybacks are just a tax-free dividend, basically, or a dividend with one less round of taxation. And then finally, the claim that selling 1% of a company and the company paying you 1% dividend are the exact same thing. That, the same goes for any real percentages there. So to start with, what I'm going to be doing is giving 2 very extreme hypothetical examples using 2 real companies that we're going to look at. And we are going to try and think through what would happen in these 2 examples and how dividend irrelevance theory is totally incapable of explaining what would happen in these extreme examples. And then we'll go back to the fact that that is also happening in even the smaller examples, even though the smaller examples, it's a little harder to wrap your head around. With these 2 very extreme examples, it should become very clear why dividend irrelevance theory doesn't really explain anything it claims to. But first, we're going to go to our first example. Okay, so let's get into the very first of my 2 examples, 2 extreme examples of real companies, and we're going to talk about a hypothetical dividend payment that both companies could do. And we're going to say, what would dividend irrelevance theory state should happen here? And you guys think about what you think should happen here, and then I'll say how I think it would go down. The first one is one you probably haven't heard of, DACO New Energy Corp. It took me a while to find a company with the exact circumstances we would need for this example, but DACO New Energy Corp, they're a Chinese holding company. They manufacture and sell components for solar panels. They have a market cap of $1.1 billion. And if we go look at their price to book, and I'm not recommending this company, I don't know anything about it, but they have a 0.3 price to book ratio. And if we go look at their financial health, and I find their balance sheet right here, you'll see they have $1.9 billion of cash. So what would happen if DACO New Energy Corp announced a one-time dividend of $1.1 billion? What would happen if DACO New Energy Corp said, we're going to pay you guys a 100% dividend. If you own $10,000 of our shares, we are going to pay you $10,000. Now, after this payment, there'll be a company with $800 million of cash. They'll have $4.8 billion of shareholder equity. They'll still have all their plants, all their equipment, all their employees, all their IP. According to dividend irrelevance theory, you're moving $1.1 billion from one pocket to the other. You have $10,000 of shares. So they're going to pay you out $10,000. They're going to be worth 0 after. Does that make any sense? Does it make any sense that this company with $800 million of cash and $4.8 billion of equity is worth literally $0? That's what dividend irrelevance theory would imply. Now, let me go look at my second example. NVIDIA. I think we all have heard of NVIDIA, $5.1 trillion market cap. If we go look at their valuation, they have a price to book ratio of 26.2. If we go look at their balance sheet, they have 195 billion of equity. So what would happen if NVIDIA said, we're going to liquidate our entire company, all of this. We're going to sell our physical assets. We're going to sell our inventories. We're going to make everyone pay us our receivables, all our long-term assets, all our bonds, whatever, investments in other companies. I don't know. We're going to sell all of that, and we're going to pay it out to shareholders in a one-time investment. After that, NVIDIA will be a company with literally no assets, and it will have $50 billion of equity. It won't have any plants, won't have any IP, won't have any employees, won't have any offices, won't have anything, right? So I asked the AI chat earlier, what's the assets per share of NVIDIA? $10.71 per share. So if NVIDIA announced a one-time dividend of $10.7, $10.70, they're going to pay to every shareholder. Dividend Irrelevance Theory says, well, NVIDIA's worth about 211 per share. After this, it would be about 200 flat. This company that has no assets, no nothing, and only liabilities, according to Dividend Irrelevance Theory, would still be worth $200 a share. It would still be worth about like $4.5 trillion. Does that make any sense? No. So once again, pause the video and think about what you think would happen in both of these situations, and then I'll give my explanation of what would happen. My explanation of what would happen is that arbitragers would step in and they would do this math. What is the company going to be worth after the dividend happens? And then how much is the dividend? And we're going to add those two numbers together, and we're going to time discount the dividend. So now DACO Energy Corp becomes, in a month's time, let's say, it's going to be this new company with $800 million of cash. How much is that company worth? Well, they're at a price to book of 0.3. So let me see. I did the math. So it would remove 0.33 from the market cap if they got rid of this cash, this $1.1 billion times the 0.3 in the market's value at. It would take 0.33 off the market cap. So this would become an $800 million company. Okay. And that $800 million company would have a $1.1 billion payment that's coming, and the value of the stock would be the value after the payment plus the payment, and then slightly discounted. So it would become about a $1.9 billion company. The moment the payment happens, it would then become an $800 million company, right? So the same thing, let's go look at NVIDIA. My explanation of what will happen to NVIDIA is that arbitragers are going to look at NVIDIA and say, what's the new NVIDIA going to be worth after they've paid out their dividend and no longer have any assets and only have liabilities? Well, I think they would say that company's worth zero. That company's worth actually zero. And then they'd say, okay, but it's a company that's worth zero, but it is going to pay us out $10.70 per share. A little time discount on that. I think NVIDIA would go down to about $10.50 per share when they make this announcement. Probably the shareholders would also riot and sue and force them to not do it, but whatever. Let's say it's going through. NVIDIA would go down to $10 a share. NVIDIA would lose 95% of its value overnight when they announce this dividend. And then on the dividend day, the remaining $10.70 would come off the share price. The shares would be worth like 5 cents a share or something, just on that. I don't know. So that is my model of what is actually going on with these dividends in opposition to Dividend Irrelevance Theory. On the day of the dividend, it does drop by the amount of the dividend. But leading up to that, arbitragers are doing that math. What's the company worth after? What's the dividend? Add those together, discount the dividend a little. That's what's actually happening. So now that we've talked about those crazy examples of massive one-time theoretical dividends of either the entire company's market cap or the entire company's assets, let's talk about a real company that's paying real dividends and just explain how my theory works. Again, with a much more grounded example. Procter & Gamble is a dividend king. They've been paying and raising their dividend for over 50 years, right? If we look at this, you can predictably expect when this dividend's coming in. So first of all, I would say that there are two separate combined entities being factored in by the market. There is this growing payout, right? Going off camera, but growing payout. And that is being time discounted. The further out the payout is, the more they discount it. And as it gets closer, that goes up. And then there is the underlying company, and it is in the company's plan. Let me look up here that they're paying out 61% as a dividend. They're doing another 1% buyback yield. So it's like 80%-ish of their, is this EBIT earnings or is this earnings? I think it's net earnings. 80% of their net earnings, this company will always be handing 80% of its net earnings away. So you're getting that cash flow counted in, well, especially the dividend counted in, discounted, and then you are getting what the underlying company is going to be doing, which is growing 3%, 2%, somewhere in that ballpark, matching inflation, basically. If they stop paying that out, if suddenly they were retaining 5 times more earnings and reinvesting that and doing acquisitions and building new plants or whatever, then I would say that they would be growing more than 3%. Now, it might be a bad idea. They might, when a company gets big enough and they've fully saturated the market, they start to run out of efficient ways to deploy capital, and then handing it back to shareholders is one of the best ways. But that is my model of what's going on here. It is not one combined entity. It's just changing where the money is. It is one, the cash flows that's going to hand to shareholders. Cash flows is probably not the right word, but the dividend payments that shareholders are expecting, the shareholder yield they are expecting, all time discounted, and then underlying the actual company itself, which is growing in spite of the fact it is handing 80% of its earnings away. The combination of those two things is what comes to its value and its performance. So in the case of the dividend irrelevance theory example, they always give 2 side-by-side companies. One pays a dividend, one doesn't. And you end up with the same total yield after some time. With the original example I gave, one that is worth $20 a share, the other is worth $15 a share, and it paid $5 of dividends over the time. I think this depends on the company, how well the company can deploy cash. So if we look at, let's just say, I just pulled up GM here because I think car companies are a decent example of this. If GM, instead of doing this insane buyback yield, dividend yield, I think it's more than all their earnings they're paying out. They're probably dipping into reserves to pay out this big buyback. If instead of that, they invested that all in building, 5 times as many cars. They can't sell 5 times as many cars. There aren't 5 times more people looking to buy cars. So for them, returning the money to shareholders is better than reinvesting it into the business. So if you had the two side by side, a GM making 5 times as many cars and they can't sell them, and a GM that's just handing the money to shareholders, the one that's handing the money to shareholders will have had a higher yield. If you look at NVIDIA, if NVIDIA was handing back 100% of its earnings straight to shareholders instead of reinvesting it in the business, the one that's doing that would end up worth much less than the one that's reinvesting into the business. We can once again go to hypothetical land. Imagine I have 2 companies. One is a company that its business model is it puts money on a conveyor belt and it goes into an incinerator. That's the company. Now, is the version of that company that leaves all the money on the conveyor belt going into the incinerator going to be worth more or less than the one that takes half of it off and returns it to shareholders? What's going to make shareholders more wealthy? Let's take another company. This one takes money and literally transfigures it into gold through alchemy. Is the company that takes half the money out and hands it to shareholders before it can turn it into gold, is that one going to end up worth more or less than the one that leaves it there and turns it all to gold? I think it's pretty clear what I'm getting at here. It depends on the company. It depends on how well they can deploy their capital, whether or not returning it to shareholders is going to make shareholders more or less wealthy at the end of everything. So I feel like that's enough of attacking this first pillar, and I'm moving on to the second pillar now. And that's another idea that dividend irrelevance theory proposes that I disagree with, that buybacks are just tax-free dividends. They're just superior dividends. It's another way for management to give the shareholders money, but it's just more efficient. It's just a better way for them to move the $1 from one pocket to the other pocket. Now, first of all, tax-free accounts exist. Here in the USA, I have a Roth IRA, and if there is a stock I like that pays a heavy dividend, I'll put it in my Roth IRA and not pay taxes on those dividends. Secondly, the dividends return is going to be based on your cost basis, right? Or the buybacks return is going to be based on the current price of the stock. If you buy a stock it has a 3% dividend, and then the stock price doubles, it will have a 1.5% dividend, but your yield on cost, your dividend yield on what you paid, is still 3%. If the company is doing a 3% buyback and the stock price doubles, you are getting 1.5% yield on that buyback. It does not care about your cost basis. Your share has as the same amount of money to buy more shares with. It just gets half as many shares, right? Another thing is that buybacks, they are, like I said, the stock buying itself is one way to look at it. Another is they're buying shares and lighting them on fire. But let's looking at it as the share buying more shares equally explains it. It would be the same as if the share bought gold, or if the share bought silver, or if the share bought Bitcoin, or if the share bought shares of another company. So I would say that it would be pretty crazy looking at it that way to say that it doesn't matter what asset it buys or what price it pays for that asset. It's all the same as if it just gave you the money. If they bought a bunch of gold for dirt cheap, or they bought a bunch of gold too expensive, or if they handed you the cash, it's the same. If the share buys itself for cheap, if it buys itself for expensive, or it hands you the cash, it's all the same. That conveyor belt company buying shares of itself versus that turning money into gold company buys shares of itself, that they're both equal to paying out the dividend. I think that is totally disagreeable. It totally depends on the quality of the company and the current price, if it's trading above or below its intrinsic value. So the third pillar of dividend irrelevance theory that I wanted to go after in this video is this idea that selling 1% of your stock is the same as getting paid a 1% dividend, that you can make your own dividends by selling stock as you please and the amounts you please for the payouts you need. So first of all, I have issues with this because it comes up a lot in retirement, retiring on dividends versus retiring by selling a portion of your portfolio, which exposes you greatly to sequence risk. If there's a market crash early on, then you are selling shares at the worst possible time to be selling shares when the market's crashing. But if your company can pay a reliable 3% dividend or whatever, then that is stable. If they're making the money, Procter and Gamble, let's say, they're going to keep paying and raising that dividend. So if the market crashes, that really doesn't matter to you. It'll go back up. You won't have lost anything. But if you're selling shares, then you're having to sell them during dips, when it's the worst time to be selling them. I think another example we can look at to once again point out how this just doesn't pass the acid test of some of these extreme situations we looked at earlier. NVIDIA, the NVIDIA case, is NVIDIA paying a 5% dividend the same as selling 5% of your NVIDIA shares? No, because them paying a 5% dividend actually would reduce the value of the company by 100%, whereas selling the 5% of your shares means that you've reduced the value of what your ownership by 5%. If we think of the Daqo New Energy Corp, the Chinese solar panel company, is them paying their 100% dividend the same as selling 100% of your shares? No, because them paying that 100% dividend only reduced the value of the company by like 30% or so. So I feel like that's most of what I was looking to get out about this topic. It's something I felt like I had some disagreements with the common understanding of, and I felt I wanted to get them out. There's some more intangible things I could talk about. I guess I will for a quick second here. But there's things like dividends signaling strength to the market. But the same could be said about buybacks. One big thing that I don't think many people think so much about is the kind of temperament of the current shareholders of a stock. So we can go back to Procter and Gamble, which I don't own. I don't necessarily recommend. It's just a classic example of a dividends king, right? If they suddenly cut their dividend in half, it would be disastrous for the stock, even though it might make the company more valuable to the weighing machine, maybe, who knows? But to the voting machine would freak out because the people who own the stock right now own it for that dividend. It's included in a bunch of indexes because of that dividend. If they cut the dividend, a bunch of indexes would be forced to sell the stock. A bunch of people who own the stock for the dividend payout would suddenly no longer be interested. A lot of people who hold the stock will be looking to sell the stock, and until the stock finds a new batch of shareholders who own it for different reasons, it would crater it in the voting machine. But I feel like in general, that's really all I wanted to get out on this topic. This is my first video for this channel. I've been kind of obsessing about stocks and finances for the last couple of years, and I feel like I know enough now to not make a total ass of myself when I talk about it. There's a lot I want to talk about. I love getting this stuff out, so I'm probably going to do some more videos like this. I'm probably going to do videos analyzing specific stocks, videos going over kind of famous investors and lessons that can be learned from them. I might do book reviews. Who knows? Who knows? I don't think every video is going to be like this, but I thought that this was a decent video to introduce people to myself and the channel. Give me any feedback. First of all, if you think I strawman dividend irrelevance theory, if I miss some major point, you could say that, you know, either way, dividend, no dividend, buyback. Some of these crazy examples, NVIDIA liquidating is what would cause the crash. But I would say if NVIDIA held the cash, then it wouldn't go quite as low because people are like, oh, they might reinvest it into something bigger and better. Who knows? If they did the buyback, it's worse than the dividend. If they did the dividend, it's like kind of the baseline, right? But and maybe, like I said, I may have strawman dividend irrelevance theory a bit, but these are all, I think all three of those pillars are things that a dividend irrelevance theory believer would say. So yeah, go ahead and subscribe if you like the channel, if you want to see more of this content. If you have any feedback about the style, you know, I didn't love using AI art for everything, but it's kind of quick and easy and gets the point across. I tried to show my face a little too, and use my real voice, of course. But yeah, so give me some feedback. Feel free to subscribe, and I'm going to make sure to post some more content. I might do some book reviews of some investing books I've read. I think another idea I've had is to kind of do breakdowns on how to analyze specific sectors. Every sector needs to be analyzed in its own way, and a lot of them I'm still learning. Or I could go over my methods, or if there's anything you'd like to hear me talk about, please go ahead and ask, and I would be happy to.